Hi, welcome to the channel. In this video, we're going to be looking at the three government pensions in Canada: the Canada Pension Plan, CPP, the Old Age Security Benefit, OAS, and the Guaranteed Income Supplement, GIS. We're going to be looking at how these three government pensions work together to create a base level of retirement income in Canada. Depending on your target retirement spending, these three government pensions, the Canada Pension Plan, the Old Age Security, and the Guaranteed Income Supplement, can easily make up 30 to 50% of your retirement spending. If you are moderate or lower income in retirement, then these three government pensions can easily make up 80, 90, or 100% of your retirement income. So understanding how they work, how they interact, is an important part of every retirement plan. My name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of adviicelite.ca and adviicelite.ca. When it comes to retirement planning in Canada, we know that advisors aren't doing enough to create retirement plans, especially for average Canadians. That is why we made AdviceLite available directly to you so that you can create your own retirement plan. AdviceLite is specifically tailored for average Canadians with under $500,000 in financial assets or under $10,000 per year in pension income. AdviceLite looks at Guaranteed Income Supplement, Canada Pension Plan, Old Age Security, and other factors, helping you maximize these benefits and navigate those rules. It's specifically tailored to help you improve your retirement plan. If you have under $500,000 in financial assets, then consider subscribing for more retirement planning strategies tailored specifically to you. Let's start with the Canada Pension Plan. So the Canada Pension Plan, or the CPP benefit, is based entirely on your contributions to the Canada Pension Plan. To get the maximum base CPP benefit, you need between 35 and 39 years of maximum contributions. To get the maximum enhanced CPP benefit, or CPP2, you need up to 40 years of maximum contributions to the new enhanced benefit. Every year that you contribute to the Canada Pension Plan, you get a credit to your future benefit. The maximum CPP benefit at the moment is $18,092 per year, but that's the maximum. And most people don't get the maximum, they get somewhere around the average. The average CPP benefit at the moment is about $10,524 per year. It's pretty hard to get the maximum CPP benefit, so you're probably going to get somewhere below the maximum benefit when you retire. As I mentioned, the CPP benefit is based on your contributions, and now there are two benefits. There's the base CPP benefit and the new enhanced CPP benefit, sometimes called CPP2. The base benefit requires between 35 and 39 years of maximum contributions above the YMPE, the year's maximum pensionable earnings. If you contribute the max every year for 35 years and you start your CPP at age 60, then you will get the maximum CPP benefit. If you wait to start your CPP until age 65, then you need 39 years of maximum contributions to get the maximum benefit at age 65. But that's just the base CPP benefit. There's also the enhanced CPP that started rolling out a few years ago. For that new enhanced CPP, or CPP2, it requires 40 years of maximum contributions to get the max benefit. Because it just started rolling out, nobody's going to get the max benefit quite yet, but as you contribute more and more to CPP2, your new enhanced benefit, the new additional CPP2 benefit, continues to go up every year. So if you're still 5 to 10 years away from retirement, your CPP enhancement, your CPP2 benefit, could grow to be quite large by the time you retire. Now, we highly recommend doing a CPP estimate as part of your retirement plan. Because of the new CPP enhancement, the calculation can become quite complex. So we recommend using a platform like AdviceLite to do a dynamic estimate of your CPP benefit based on your statement of contributions and your future income assumptions until you reach retirement. Depending on how early you retire or how many lower or zero earning years you have in your history, you may not get the maximum CPP benefit when you retire. Now, the other important thing to mention about the Canada Pension Plan, your CPP benefit, is that you can start as early as age 60 or as late as age 70, Depending on when you choose to start your CPP benefit, you may have an actuarial adjustment that changes how much you might receive. If you choose to start CPP earlier, there's a 7.2% reduction for each year that you start below the age of 65. So if you choose to start the earliest age at age 60, there's a 36% reduction to the CPP benefit that you otherwise would have received at age 65. You're only going to get at most 64% of that age 65 benefit. This actuarial adjustment is important when deciding when to start your CPP. If you choose to start your CPP later, you get an 8.4% increase for every year after age 65. So if you choose to wait the latest date until age 70, you'll get a 42% increase to your CPP benefit that you otherwise would have received at age 65. This provides an incentive for you to delay your CPP start age until age 70 at the latest. Now, as I mentioned, the timing of your CPP start age is very important within your retirement plan. So as you're creating your retirement plan, think about when you want to start those benefits. There might be an impact to your guaranteed income supplement, your GIS benefit. There might be an impact to other benefits that you may be eligible for. There's going to be an impact to your tax planning as well. So think about the timing for your CPP benefit in the context of all of those other factors. You can use AdviiceLite to help you explore different CPP start ages. The AI strategy for CPP start age will show you the result of every CPP start age between age 60 and 70. It will take into account your specific situation, the benefits you may qualify for, including guaranteed income supplement, and provide you with an insight into when it might be best for you to start your CPP in retirement. You don't want to make a CPP start age decision just based on rules of thumb or general guidelines. You want to make an informed decision based on your specific situation. Now, the second retirement pension, the second government pension we want to talk about is the Old Age Security Benefit, or OAS. OAS, unlike CPP, is based entirely on residency. There's no contributions. So depending on if you are a permanent resident or a Canadian citizen, as long as you've had 40 years of residency in Canada, you'll be eligible for the maximum old age security benefit. At the moment, the maximum is $8,908 per year, but that goes up every quarter with inflation. So that's going to go up with inflation over time. Now, this maximum benefit is based on 40 years of residency in Canada. You need a minimum of 10 years to receive at least a partial OAS benefit. For example, if you have 10 out of the 40 required years in Canada, you'll get a quarter of the maximum benefit, or 25% of the maximum. If you have 20 out of 40 years of the required years in Canada, then you'll get 50%, or half of the maximum old age security benefit. So it's entirely based on residency, and as long as you've got over 10 years, it's just a ratio. It's just a percentage of the maximum, the required 40 years to get the maximum. Old age security is a taxable benefit, just like the Canada Pension Plan. And just like the Canada Pension Plan, there is an actuarial adjustment if you choose to delay your old age security start age past age 65. But it's not quite as generous as the CPP adjustment. If you choose to delay your old age security past the age of 65, you get a 7.2% increase for each year that you delay. So if you delay until age 70, then you'll get a 36% increase to your old age security benefit. That's less than the 42% increase that you would get for the Canada Pension Plan if you delayed the same 5 years from 65 until 70. So typically, if we're going to delay any of those benefits, it's usually going to be the Canada Pension Plan. We'd rather delay the Canada Pension Plan first because there's a larger incentive, a larger actuarial adjustment for delaying the Canada Pension Plan versus the old age security benefit. It is also very important to highlight that old age security is tied to guaranteed income supplement, GIS benefits. You cannot receive your guaranteed income supplement without having started your old age security. So it's important to think about whether or not you qualify for guaranteed income supplement, GIS, and that will also inform whether or not you should be starting your old age security or OAS benefit. The other interesting thing about old age security is that there's a 10% increase at the age of 75. This has nothing to do with when you started your old age security benefit. Everybody gets a 10% bump to whatever they were receiving at age 74. They get a 10% bump when they turn age 75. So look forward to that within your retirement plan. The last thing to highlight with old age security is that there is a clawback on this benefit. If your taxable income is higher than $95,323 at the moment, you will experience a 15% reduction in your old age security benefit for every dollar above that threshold. So for example, if you had an extra $1,000 of taxable income above that threshold, you would see your old age security go down by $150. That's the old age security clawback, or officially the old age security recovery tax. The last government pension that we want to talk about, and probably the largest and most generous, is the Guaranteed Income Supplement, GIS. GIS benefits are quite generous. GIS is also a non-taxable benefit. Whatever Service Canada says you will receive, depending on if you qualify, whatever they say you will receive, that is what will hit your bank account every month. As I mentioned, GIS is a very generous government benefit. At a maximum, it's worth $13,305 per year for an individual. It's worth up to $16,018 per year for a couple. And at the moment, it's worth up to $24,925 per year for a couple, with a small age gap if they're eligible for GIS allowance. However, these amounts are dramatically reduced by GIS clawbacks. GIS clawbacks are based on your income. They are what we call an income-tested government benefits. The amount you receive will go down depending on how much taxable income you have. Specifically, it's based on line 23600 on your tax return. This is called net income for tax purposes. This is different than the net income you might be used to on your pay stub. But it's even a bit more complicated than that. Your GIS benefit, when Service Canada evaluates your eligibility for GIS, it's based on line 23600 on your tax return, but then there are additional adjustments that are made depending on your sources of income. For example, you have a full exemption for old age security income. So even though old age security is a taxable benefit, even though old age security is included in line 23600 on your tax return, it is excluded, it is removed from the GIS eligibility calculation. You also have a full exemption for the first $5,000 of employment income. So even though employment income is taxable, even though it's included in line 23600 on your tax return, the first $5,000 is excluded from the GIS clawback calculation. In fact, the next $10,000, so going from $5,000 of employment income to $15,000 of employment income, that receives a partial exemption of 50% when they do the GIS clawback calculation. So there are a number of adjustments made to line 23600 on your tax return when they're evaluating your eligibility for the Guaranteed Income Supplement. Included in line 23600 on your tax return is the Canada Pension Plan payments that you might be receiving. So the more you get from the Canada Pension Plan, the larger your Guaranteed Income Supplement, your GIS clawbacks. This is why the timing of CPP is so important. Sometimes it makes sense to start CPP earlier to reduce the clawbacks in the future. Sometimes it makes sense to start your CPP later to reduce clawbacks between age 65 and 70. It just depends on your situation. It depends on the specifics within your plan. So as you're creating a retirement plan, take a look at your GIS benefit as well as your CPP start age and make sure you account for the interaction between those two benefits. Now, line 23600 also includes income sources like RSP and RIF withdrawals, as well as pension income from a defined benefit pension plan. So as you're creating a retirement plan, if you're eligible for Guaranteed Income Supplement in the future, you need to think about all of those different income sources, when they start, how much you're withdrawing, and how that may affect your guaranteed income supplement. All of these factors make planning around the guaranteed income supplement GIS benefit a little bit more complicated. However, if you can properly navigate all of these different rules, it can have a very positive impact on your retirement plan. So how much guaranteed income supplement you end up receiving is going to depend on all of those different income sources, when they start and stop, how much you might be receiving. This makes that sort of planning very important. You're probably not going to get the maximum GIS benefit. You're probably going to get something a little bit lower, but if we can, we want to avoid as much of those GIS clawbacks as we can. Now, these three government pensions, when combined, can be quite generous, and if we can navigate the rules properly, it can really help improve a retirement plan. Here we're in the Advice Lite platform. We're going to look at a case study that we're going to post on the channel in a couple of weeks. So if you want to take a look at that case study, make sure you subscribe. This is Paul and Brenda. Paul and Brenda have about $400,000 in financial assets. So they're doing okay. They're not extremely wealthy, but they're going to have a comfortable retirement if we can help them navigate some of these rules. They also have a home as well that's fully paid off, and they want to spend about $60,000 per year over the course of retirement. So it's a fairly generous level of retirement spending. Now, we want to use their assets in the best way we possibly can. So if we go to the income tab here, we can see a couple of things. One I'll point out is the lifetime GIS benefit. In their case, for Paul and Brenda, it's worth $148,000. So again, we want to make sure we're planning around the guaranteed income supplement because it can be quite generous over the course of retirement. We're also getting about $800,000 from lifetime CPP benefits and about $550,000, $570,000 in lifetime old age security benefits. Now let's look at some of the specifics in their plan because it will highlight some of those things we were talking about. So one of them is because Paul and Brenda have a small age gap, they are eligible for that larger GIS plus GIS allowance payment. So they're getting a fairly large amount of non-taxable income for a couple of years until Brenda turns age 65. So at that point it reduces, but it's still quite a generous benefit. Now, the other thing we've done in this plan, and you'll see it if you watch the full case study, is we've chosen to delay the Canada Pension Plan until age 70. What that does is it allows us to qualify for a larger amount of GIS benefits for a few years between age 65 and 70. Now, the other thing we've done is we've enabled some strategies here, and I'll show you one of them. So one of them here is we've enabled that CPP start age. So we've used the AI strategies to tell us when the best CPP start age is. But the other one is we've done a maximize GIS strategy. So we've made strategic RSP contributions between Paul's age 66 and 70 and Brenda's age 64 and 69. And those help us qualify for the maximum GIS benefit for a few additional years. So even though they've got $400,000 in financial assets, even though they've got a relatively healthy amount coming from Canada Pension Plan, Paul and Brenda have been able to qualify for GIS earlier in their plan than they otherwise would have because we've navigated these rules a little bit better. Now, the other thing Paul and Brenda have in their plan is they've got some employment income, but they've been smart and they've kept it below that exemption. So they're each earning about $5,000 per year in that early part of retirement, and that's giving them $10,000 of income that's essentially non-taxable because of all the other tax credits they receive, and it's not causing any clawbacks on their guaranteed income supplement. Now, we've done a couple other things within this plan to help improve it, so make sure you subscribe so you can see the full case study when it comes out. If you want to build a retirement plan like this for yourself, go to adviicelite.ca. You can get started for just $9 a month or $49 for the year. You get access to the software platform, the AI strategies to help improve your retirement plan, and you get access to our community forum for support, questions, and discussion, as well as our bi-monthly webinars. So we do a number of webinars every month, getting started webinars, as well as office hours webinars and case study webinars as well. So you get access to all of that for just $9 a month or $49 for the year. Thanks for watching the video. I hope you now appreciate how much nuance there is with the Canada Pension Plan, the Old Age Security Benefit, and the Guaranteed Income Supplement, the timing of these benefits, how important it is, the actuarial adjustment, the benefit for delaying those benefits, the incentive, as well as the clawbacks on the Guaranteed Income Supplement and how complex they are. I would encourage you, if you have under $500,000 in financial assets, if you have under $10,000 per year in defined benefit pension income, go to adviicelite.ca. Go start a retirement plan. Use the AI strategies to help you navigate all of these benefit rules and clawback rules so that you can get the most out of your retirement plan. Thanks so much for watching. I hope you like and subscribe, and we'll see you at the next one.